Welcome back. If you're feeling a little poorer these days, you're not alone. Here's a look at the declining wealth of Canadians by the numbers. New data from StatsCan pegs the average net worth of Canadians at just under $1 million in the 3 months ended June 30th. That's a decline of 6.5% from the first 3 months of this year, a drop of $65,400. The two bottom tiers of net worth suffered the most. Their average worth of $64,800 declined a full 12% in the quarter. For the wealthiest, who saw a drop in worth of almost $200,000, financial assets like stocks down more than $123,000 and real estate down about $78,500 were both to blame. But by far the biggest hit was on the very youngest and the very oldest. Seniors saw their net worth fall 2.86%, while Canadians aged 35 and younger saw a drop of 2.85%. And while wages of the lowest wealth groups rose the most, up 11.3%, their disposable income fell further as inflationary pressure hit everything from rent to food costs. That makes the gap between rich and poor groups in Canada wider than ever, from the top two groups to the bottom two, a yawning delta of 46.3%. The jobs picture in September only reinforced a growing trend in Canada, with 20,000 people leaving the workforce, making a tight labor market even tighter. How will a recession feel different when there are jobs to be had? Stephen Brown is Senior Canada Economist with Capital Economics. Stephen, great to have you with us.
It's a pleasure to be with you.
I actually want to start with, have we ever been here before heading into an almost certain recession, but with a very tight labor market and kind of holding up fairly tight?
You know, it's actually quite similar to what we saw in the 1970s. I think economists spent most of the last 2 years saying how this isn't the 1970s, and then suddenly we're drawing all these comparisons how it's actually quite similar to the 1970s. So back then we saw, certainly in the US, we saw quite a deep recession, but a jobful recession, as the phrase was, where employment actually held up relatively well. One of the differences back then, it was more about union power, whereas today it's just this broad demand for labor across the economy. So it's definitely a different situation. History always rhymes. This one does feel a bit different. But we probably are heading into a situation where firms are going to be less willing to lay off workers than they have been in the past. And I think that's ultimately good news. Obviously, it's good news for the people that might be worried about losing their jobs. But it's also good news from a broader macroeconomic perspective, because it reduces the chance that an initial downturn turns into something worse, because we have that round of layoffs and people have to stop spending because they're not getting an income anymore.
Yeah, the question, of course, is do you even notice it's a recession if you've still got your income, your job is intact? One thing that you and other economists have spent some time looking at are the folks that have left the workforce, and particularly those early retirees, the 55 to 64, who suddenly seem to be leaving in droves. Do you think there's a kind of a need to pull them back into the market? And is there any kind of, have we ever seen that before, where we try to coax people out of early retirement to come back to work?
Yeah, it's a tricky question in terms of, if we coax people back now, obviously eventually they would leave again because, they want to retire eventually. So it's a problem that needs solving, but whether we could just kick the can down the road or not is a different question. I think that the benefit for Canada is that at least we do have this strong wave of immigration. So the initial sort of labour force weakness we saw at the start of the year was certainly retirements. But then over the summer, we saw a bit of labour force growth, certainly in the August data, as the population started picking up again. So I think in the next few months, we can actually be fairly confident that labour force probably won't drop back that much. Retirements have actually sort of stabilised. The weakness you mentioned in September, that was more about young people going back to full-time education after participation had jumped during the pandemic and dropped back down again. So I think the next few months probably will be okay for the labour force, but it really depends on what happens, if the economy does weaken and then we sort of see people dropping out. So let's say that the bank is trying to normalize supply and demand. So if we get a bit of weakness in demand, but then more people drop out of the labor force again because they just don't think it's worth working for, say, a lower wage, then the bank is in the same problem where the supply and demand is out of balance, and it ends up having to do more and more of it than it thought it was going to. So it's certainly a bit of a challenge for the Bank of Canada at the moment. I think one thing that's clear though now is that it's going to have to keep tightening until wage growth comes down again, and that in that situation, it's hard to see how we avoid a recession at this point, even if it is a relatively moderate one by the standards of a pandemic, say.
Stephen, so good to have you.
Great. Pleasure to be with you.
Stephen Brown, Senior Canada Economist at Capital Economics. One of the big concerns about rising rates is that people lose confidence and a recession becomes a self-fulfilling prophecy. That may be happening when it comes to the rate of new business openings. In second quarter, there were half the usual number of startups. So what's behind the hesitancy? Jeff Brown is the head of commercial solutions at Equifax Canada. Jeff, great to have you with us.
Thanks for having me, Amanda.
So instead of the usual 100,000 new business openings we would expect to see, we saw half of that. What is playing into the psyche of people that would be starting businesses but are not?
It's tough right now. Right now, we're operating in a completely uncomfortable time period. We have the cost of goods increasing with the rise of inflation. We have the cost of capital increasing with increased interest rates, supply chain issues, demand for increased wages, and all of this with small businesses taking on more and more debt. So it's really uncomfortable, kind of a perfect or imperfect storm for new business owners.
So we tend to think of small businesses as the engine of growth and a pretty important contributor to the growth in jobs. I know it's hard to say what would happen when something doesn't happen, but do you look at this data and say that is actually a forecast of something quite negative coming? Weaker jobs, weaker overall investment, whatever happens after this is not a good thing.
Absolutely. I mean, it is deeply concerning. And to put those numbers into context, typically in Q2, so April from June every year, Canada has a big surge in terms of number of small businesses that open up. So anywhere between 90,000 and 100,000 small businesses. So to see half of that, especially as we're coming off kind of the heels of the pandemic, it's really concerning. So we monitor new businesses that start up and become financially active. So buying goods and services, because businesses need to be, spending money to make money. So it's going to have a lot of downturn, I guess, long-term effects with big suppliers as well. So not only small businesses not spending money, it's going to affect the suppliers and financial institutions that rely on them becoming basically financially active.
And I guess for context, what jumped out at me a little bit is that not only are we 50% below last year's numbers, we're almost the same, 46% below 2019 levels. In other words, in pandemic, we actually held up pretty well. Was that because there were government supports in place, or because those new pressures, including things like inflation and a tough, tight labor market, are so bad? Or is it a combination of the both that's made the difference?
It's a combination of both, really. So if we think about small businesses in general, they're really akin to what we're seeing with basically new home buyers. The cost of entering the market, it's higher risk and high financial kind of scarcity that has happened. They have a cost of rising fuel, cost of wages. It's really just a lot of headwinds that are facing them right now. So for new business owners who are typically, blissfully optimistic, there are a lot of financial headwinds that are currently just deterring them from entering the market.
Jeff, it's so good to have you with us. Appreciate your time today.
Thank you so much.
Jeff Brown is the head of commercial solutions at Equifax Canada. Coming up, is your car on a most wanted list? Auto thefts are skyrocketing in Canada. But first, this. Leave it to a Swiss court to adjudicate a battle of the bunnies. Chocolatier Lindt won a victory against German rival Lidl over what the Swiss chocolate bunny maker said was a clear violation of its patent. The court agreed and ordered Lidl to melt down its bunnies immediately. Not destroy them, mind you, because while the shape was offensive, the chocolate is still valuable. This is Switzerland, after all. We're back after this.